This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup, the week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome, real estate enthusiasts and professionals. Welcome back to the Deep Dive.
Hey, everyone.
This is where we take that stack of information, all the articles, the research, our notes, and really trying to distill it down into the most important nuggets of knowledge just for you.
Yep, that's the goal.
Our mission today, we're going to unpack the past week's biggest real estate news, the key trends, and we're drawing specifically from that rich collection of sources that fed right into our recent weekly roundup from The Wire.
Right. Consider this your essential briefing.
Exactly. We're trying to cut through all the noise for you.
That's right. We're here to help you, move beyond just scanning headlines. We want to dive deep, really identify the most significant themes that are popping up, and uncover those sometimes surprising insights that are truly shaping the housing market right now.
Yeah.
Our goal is really to connect the dots for you, provide some actionable takeaways, and give you that crucial context, the kind that can make a real difference in your decisions.
Whether you're a seasoned agent out there trying to navigate some tough conversations, maybe a savvy investor looking for that next opportunity, or even a homeowner just thinking about your options.
Precisely. That context is key.
Okay, so we've got a really fascinating mix of topics on deck for this deep dive. We're going to explore everything from the shifting dynamics and market sales data, some really interesting stuff there, to the major industry-shaping legal decisions that are making waves.
Big ones.
Big ones. And also, the truly surprising emergence of new financial frontiers. Something we touched on briefly in The Wire, but we're going to unpack it in much more detail today.
Yeah, that one's definitely worth digging into more.
Absolutely. And speaking of The Wire, we'll be taking a particularly close look at one of the standout segments we flagged, Flippers Falter, the warning signs shaking the housing market. We want to explore what that really means and how it fits into the bigger picture we're seeing develop.
Okay. Sounds like a plan.
So are you ready? Let's unpack this.
Let's do it.
Okay, let's kick things off by maybe taking the pulse of the overall market. Because what we're seeing right now, it's a fascinating mix of signals, almost contradictory sometimes. It's definitely not a simple single-direction story, and that complexity is exactly why this deep dive feels so necessary right now.
Absolutely. The data truly paints a picture of a market that's, it's in constant flux.
Yeah.
You've got some segments showing surprising resilience, really holding up, while others are clearly struggling under the persistent weight of current economic conditions, high rates, affordability issues.
The usual suspects.
Exactly. It's a classic case of needing to look well beyond just those top-line numbers to understand the profound nuances at play here.
And nowhere is that divergence clearer than when you put pending home sales right next to new home sales.
Yeah.
Let's break that down a bit.
Okay.
Our sources, we're talking CNBC, Real Estate News, Ion Housing, they consistently show that pending home sales, which, are basically contracts signed but not yet closed, they actually defied expectations in May.
Right. That was a bit of a surprise.
It really was. We saw a 1.1% year-over-year uptick. Now, for many, this sparked a real sense of hope, maybe even some cautious optimism, right, for a potential rebound in buyer activity. It suggests that underlying demand is definitely still present, perhaps just waiting for, the right conditions to fully emerge.
Like it's just simmering below the surface.
Exactly, like seeing those first green shoots after a long winter.
Yeah. But what's truly fascinating here, and maybe a bit perplexing for some folks trying to read the tea leaves, is that this encouraging movement in pending sales stands in really stark contrast to the new home sales data from the same period.
Totally different story there.
Completely. New home sales absolutely tumbled in May, hit a 7-month low, and this was reported across the board. Real Estate News, CNBC, Ion Housing all picked up on it.
Wow.
And this significant decline, it's largely attributed to those elevated interest rates we've been talking about for months. They're still hovering at levels that make borrowing expensive.
Still sticky.
Very sticky, coupled with challenging affordability conditions, particularly when you're looking at new construction. Builders, just by their nature, they have less flexibility on price.
Right. Costs are costs.
Costs are costs, rising costs of labor, materials, land development. It all means their new homes often just carry a higher price tag. So that segment of the market is certainly feeling the pinch more acutely right now.
So this divergence, this split, it raises a really interesting question for us and for you listening. What exactly does this tell us? I mean, are buyers faced with these higher rates? Are they gravitating more towards existing homes because they're seen as maybe a better value in this environment? Perhaps offering more room to negotiate or more established neighborhoods?
Or maybe less sticker shock initially.
Yeah, exactly. Or are builders simply facing greater hurdles in this current high rate, high cost environment, finding it harder to move that new inventory because the economics just don't pencil out for enough buyers? It's not just a simple question of supply versus demand anymore, is it? It's about the type of supply and the type of demand that is most active right now.
It's absolutely a combination of factors. It's a complex interplay, for sure. I mean, look at the existing home market. It often offers a wider range of price points, different locations. That provides more flexibility for buyers whose affordability has been stretched pretty thin by higher rates.
Makes sense.
Plus, you might find more opportunities for, say, a fixer-upper or a home with that unique character you just can't replicate in new construction.
Sure.
New construction, on the other hand, often comes with a premium, right? For its modern features, energy efficiency, the appeal of being brand spanking new.
Sure.
But when rates are high, that premium becomes even harder to justify for a lot of would-be homeowners. So what we're seeing is, yes, the fundamental desire for homeownership persists, but buyers are becoming far more discerning.
They have to be.
They really do. They're scrutinizing what they can truly afford, what compromises they're willing to make, and, where they feel they're getting the most bang for their buck.
And speaking of existing home sales, while they did edge higher in May, they rose 0.8% against an estimated 1.3% decline, which, let's be honest, is a positive beat against expectations.
Yeah, better than expected.
Right. But the overall sentiment from sources like Ion Housing, Real Estate News, CNBC, it's still that high rates and persistently elevated prices are keeping sales generally muted.
Not exactly booming.
Not booming at all. We're not seeing a surge. The NAR, National Association of Realtors, their May 2025 home sales report, with data from their chief economist Lawrence Yin on median home prices, it really supports this picture. Incremental, hard-won gains, not a runaway market.
And this muted market environment has very real, very tangible implications for everyone involved, for real estate agents listening.
Yeah.
It means every single sale is hard won. It's a battle fought on every front. It demands highly strategic pricing right from the get-go, razor-sharp negotiation skills, and a deep, empathetic understanding of both buyer and seller sentiment. The days of just sticking a listing up and expecting multiple over-asking offers in like an hour?
Yeah, those days are gone.
For most areas, they're firmly in the rearview mirror. Now, for buyers, this translates to a market where choices are still somewhat limited inventory. Yeah, it's improving, but it isn't abundant everywhere.
Right.
But opportunities certainly exist for those who are prepared, who've got their financing lined up, and who are ready to act decisively when the right property comes along. It's a significant shift from that frenzied seller's market of recent years.
Absolutely. Much more deliberate now.
Much more deliberate, much more informed action is required.
And this brings us to another really crucial shift we're tracking: the slowing pace of home price growth. And critically, alongside that, increasing inventory.
That's the other shoe dropping, potentially.
Potentially. We're seeing reports, including from CNBC, indicating that home price hikes are moderating more than many expected, which, is welcome news for buyers feeling squeezed.
Finally, some relief, maybe.
Maybe. This trend comes alongside significant improvements in housing inventory, as highlighted by Real Estate News, and this increased supply is directly contributing to better affordability, or at least less intense competition.
Right.
This isn't just a minor blip. It feels like a crucial pivot in the market dynamics.
Indeed. And this is where the market truly begins to rebalance itself.
Yeah.
Increased supply combined with slower price appreciation. Traditionally, fundamentally, that signals a market that is shifting power dynamics.
Towards buyers.
Exactly. Moving towards buyers, giving them more negotiation power. I mean, think about it. If there are more homes available, buyers don't feel that same intense pressure to jump on the first one they see.
Right. They can breathe a little.
They can breathe. They can be more selective, maybe make offers with contingencies. Again, imagine that. Yeah. Or negotiate more firmly on price. Sources are indicating that agents are already rethinking their pricing strategies.
They have to.
They have to adapt to buyers gaining more leverage. It's no longer about setting some aspirational price and just waiting for a bidding war. It's about being very realistic, very competitive from day one to attract attention.
And what's more, this dynamic also means that even home builders are facing increased competition, right? And not just from other builders.
That's a great point. They're now competing directly with existing homeowners who are finally choosing to sell. And maybe those existing homes offer something different, a specific location, a lower price point, unique features.
The different value proposition.
The different value proposition. This adds another layer of complexity to that new construction market, making it tougher for builders to stand out and move their product when there are more existing options available.
Okay, so we've painted this picture of mixed sales, slowing price growth, more inventory. But to really get a handle on why this is happening, we need to look under the hood, right?
Yeah.
At the financial levers and the broader economy.
Precisely. You can't understand the real estate market in a vacuum. The broader macro environment dictates so much of what we eventually see at the micro level, individual sales, local prices.
So let's start with mortgage rates. What's the latest there?
Well, they've largely held steady over the past week. This is despite a modest uptick in Treasury yields. Our sources like Ion Housing and the mortgage reports are characterizing them as being kind of stuck in a holding pattern.
Holding pattern, okay.
Now, this period of relative stability, it's maybe a welcome change after the wild swings we've seen.
Definitely.
But it also means that significant relief on borrowing costs isn't immediate. For our listeners, it's worth maybe a quick note that Treasury yields are a key benchmark. They influence long-term rates like mortgages. So even a modest rise in those yields would typically suggest mortgages might follow suit, but they haven't moved much.
Interesting.
Yeah. And this holding pattern, it kind of dampens enthusiasm for some potential buyers who are maybe sitting on the sidelines waiting for rates to drop further.
And it keeps sellers locked in too, right?
Yeah. And crucially, yes. It impacts potential sellers who are hesitant to give up their historically lower existing mortgage rates. That lock-in effect is still very much a factor.
And there's a fascinating, almost paradoxical split in perspective here that's worth highlighting, isn't there? Between, say, the housing industry and the Fed.
Oh, definitely. FHFA Director William Poult has publicly stated, and you can see this referenced in a CNBC video, that he believes Fed Chair Powell needs to lower rates to stimulate the market.
That's pretty direct.
It's a very direct public call to action, reflects a desire to, loosen the financial spigot specifically for housing. However, other sources, including reporting from Real Estate News, indicate that the Fed itself is in no rush to lower rates. Despite maybe some internal dissent, their main focus remains elsewhere.
Inflation control.
Exactly. This really highlights that ongoing tension between what parts of the market, particularly the housing sector, feel they need to see happen to thrive, and what the central bank's broader economic policy objectives are, especially concerning their primary mandate of controlling inflation and maintaining overall economic stability. It's a real tug of war between competing priorities.
And that tension is absolutely critical for the real estate market, isn't it? It basically means we can't just wait around for the Fed to swoop in and save the day with rate cuts.
That's the takeaway. It implies that real estate professionals, investors, homeowners, you can't just sit on your hands and wait for some significant Fed pivot to unlock a flood of new demand. You have to operate strategically effectively within these stable but still high rate conditions for the foreseeable future.
Right. And beyond just rates, what other economic indicators are influencing things? Consumer confidence, maybe?
Yeah, that's another key piece. Broader economic indicators play a crucial role in shaping consumer confidence, which, as Ion Housing reported, actually retreated a bit in June.
Not great news.
Not ideal. A drop in consumer confidence can significantly impact big purchase decisions like homes. People just become more cautious about their financial futures, less willing to take on large debts.
Makes sense.
And to provide an even broader economic backdrop, understanding consumer purchasing power, market vitality, we also look at things like state-level employment data for May 2025 and the Q1 state-level GDP data. Both of those were highlighted by Ion Housing.
So getting really granular there.
Exactly. These figures paint a detailed picture of regional economic health, local job growth, overall prosperity, which ultimately underpins real estate activity from the ground up. It tells you if people in a specific area actually have the jobs and income to support the housing market.
Okay, so beyond the raw numbers, the sales, the rates, the economic stats, it's becoming increasingly clear that the very I guess, foundation of the real estate industry is undergoing some pretty seismic shifts right now.
Oh, absolutely.
These aren't minor tweaks we're talking about. They're driven by landmark legal precedents, rapidly evolving business models. It's not just about how many homes are sold anymore.
No.
It's about how they're sold, who facilitates those sales, and crucially, who benefits financially from the transaction.
You're absolutely right. This is where we see these structural changes taking root that will have profound long-term impacts on the entire ecosystem of real estate. And one of the most significant developments, one that's been making headlines for months now, is the landmark commission settlements.
The NAR settlements and others.
Exactly. A judge has now given final approval to 15 of these commission settlements. Real Estate News reported on this, and this isn't just some legal formality buried in paperwork.
No, it feels huge.
It is a truly landmark decision. It could fundamentally alter how real estate agents are compensated, and in doing so, reshape the traditional buyer-broker relationship as we've known it for decades.
Can you unpack that a bit? What's the core change?
Sure. Historically, the seller's agent would typically offer a portion of their commission earned from the seller to the buyer's agent who brought the successful buyer. Now, with these settlements, that structure is changing dramatically.
How so?
It's moving towards making buyer-agent compensation more explicit, more transparent, and in many cases, potentially paid directly by the buyer rather than being baked into the seller's commission.
Wow. Okay.
The ripple effects of this are going to be felt across the entire industry, from how agents operate day-to-day, the services they offer, how they articulate their value, right, to how buyers approach the market, how they budget for their home purchase, because now they might have an explicit agent fee to consider. It's a massive shift towards transparency and, arguably, shifting responsibility.
And this broad push for transparency, which seems to be a really clear theme emerging from the past week's news, it isn't stopping just at commissions, is it?
No, it's definitely not. It's extending to referral fees as well. The multiple listing services, the MLSs, are extending their efforts to ensure greater clarity in those arrangements, too. Real Estate News covered this as well.
So if an agent refers a client to another agent, maybe out of state, and gets a fee, that's becoming much more visible now.
That's the push. It's all part of a larger systemic trend towards making the entire real estate transaction process more open, more understandable, and proponents would argue ultimately more consumer-friendly, less hidden costs, more clarity.
Okay. And coupled with these huge legal shifts, what are we seeing on the brokerage side? Consolidation, competition?
Both, actually. We're seeing a significant trend of brokerage expansions and mergers across the country. Real Estate News highlighted numerous examples just this past week.
Like what?
Well, you've got established players like RE/MAX and Christie's expanding their footprints. You're seeing New England independent brokerages merging to create larger entities, presumably for scale and efficiency. And even in a vibrant market like Chicago, indie brokerages are consolidating, all while these national, often tech-driven brands like XP Realty, that's eXp Realty, continue to aggressively expand their reach across the country.
So it definitely suggests a really dynamic and probably increasingly competitive landscape, doesn't it?
Absolutely.
It feels like smaller, independent players might be seeking strength in numbers, merging to gain the scale, the resources, maybe the tech capabilities they need to compete effectively with those larger national entities.
That seems like a very plausible driver. For some, it's likely a survival strategy in a tighter, more complex market. For others, maybe it's an offensive growth strategy. But the net effect is certainly less fragmentation in the market overall.
Yeah, and maybe a greater concentration of power and resources among fewer, larger players eventually.
That's certainly a potential long-term outcome, yes. And that increased competition isn't just about brokerage size or agent count. It's increasingly about control over vital market data, specifically listings.
The listings, always key.
Always. The competitive friction between major players here is really heating up. It's moving from maybe quiet industry disputes into very public legal battles. We saw Compass's CEO publicly ask a judge to stop Zillow's listing ban.
Right, I saw that headline.
Yeah, escalating what was initially maybe a more private listings fight. And Compass is also directly suing Zillow over this issue now. Real Estate News reported on both the request and the lawsuit.
So this isn't just corporate drama. This is really a fight over who controls the information flow.
Precisely. It's about how agents can best market properties in the digital age.
Listing data is, it's the absolute lifeblood of this industry.
That's a critical point. This legal battle really underscores the vital importance of listing control and data access in today's digital real estate market. It's fundamentally a fight over who controls that information flow, where properties get displayed online, and how effectively agents can market those properties to the widest possible audience. So for you, our listener, how does this impact your day-to-day? Well, for agents, it highlights the increasing challenges, the complexities of ensuring their listings get seen across various platforms, avoiding potential blocks, or maybe paying higher fees.
Yeah, navigating that landscape is getting trickier. And for consumers, it directly influences where and how properties are discoverable online. It could potentially affect the breadth of options you see when you're searching for your next home, depending on which websites or apps you use.
Right. Your search results might actually be curated by these ongoing legal battles, not just by pure market availability, which is a strange thought.
It really is. Okay, moving on to something you flagged earlier as potentially groundbreaking.
Yes. This next development we're going to discuss is, I think, truly groundbreaking. It points to a significant and maybe quite unexpected future direction for real estate finance.
Okay, intriguing.
This is one of those insights that, if you just glance at the headline, you might miss the full implications, but it could radically alter the landscape of how homes are bought and sold down the line.
All right, lay it on us. This sounds genuinely exciting, maybe even a little bit like science fiction for some people listening.
Well, yeah, hold on to your hats a bit here, because the Federal Housing Finance Agency,
The FHFA.
right, the regulator for Fannie and Freddie. Exactly. For those who aren't familiar, that's the federal agency regulating Fannie Mae and Freddie Mac, the government-sponsored entities, the GSEs, that essentially buy and guarantee the vast majority of mortgages in the U.S. Huge players.
Massive.
Well, the FHFA is actively preparing to consider cryptocurrencies as an acceptable asset for mortgages.
Wow. Okay, say that again. Cryptocurrencies.
Cryptocurrencies as an acceptable asset for mortgages. And this isn't just some fringe idea being floated by, some crypto startup in a basement.
Doesn't sound like it coming from the FHFA.
No. This initiative actually seems to have some political endorsement, with references to a Trump crypto mortgage even appearing in CNBC News coverage.
Okay.
So this isn't just about people investing in crypto. This is about its potential integration into traditional mortgage underwriting.
How you qualify for the loan itself.
Exactly,
Yeah.
which could truly revolutionize how buyers secure financing. Now, while this move offers potential efficiency, maybe speed, imagine near-instant verification of digital assets.
Yeah, I can see that.
It also, understandably, introduces new complexities and, of course, the inherent volatility that we all know defines the crypto market. That's the big elephant in the room.
That's astonishing, truly. The idea that Fannie Mae and Freddie Mac might start looking at digital assets, Bitcoin, Ethereum, maybe even meme coins like DOGE, that's DAO for our listeners,
Right.
as part of a borrower's financial profile for underwriting a mortgage. That is a huge, huge leap. It really challenges the very definition of what a stable asset for traditional lending might even mean.
And this is precisely the surprising insight we really wanted to highlight from the past week's news flow. FHFA Director William Polt has explicitly been discussing the use of crypto in mortgage underwriting for Fannie Mae and Freddie Mac. World Property Journal picked up on this too.
So it's public, it's explicit.
Public, explicit. This move by government-backed entities, the bedrock of the U.S. mortgage market, to even consider digital assets as a legitimate part of a borrower's financial profile. It marks a truly significant leap towards mainstream adoption and, legitimization of cryptocurrencies within the real estate sphere.
Yeah, that's way beyond just niche speculation.
Absolutely. It's a clear signal that this isn't just relegated to tech enthusiasts anymore. In fact, Fed Chair Powell himself has noted, according to a CNBC video, a significant change in tone around digital assets within the broader financial sector.
So even the Fed is acknowledging this shift in attitude.
They are. This isn't just a quiet conversation happening among crypto fans. It's now becoming a central mainstream financial discussion with very real-world potential implications for housing.
Okay, so let's speculate a bit. If this actually moves forward, what are the immediate risks and opportunities for, say, early adopters of this kind of financial innovation?
Good question.
On one hand, like you said, it could dramatically open up homeownership to people who have significant crypto holdings, but maybe less traditional liquid assets, right? Maybe they bought Bitcoin years ago and are sitting on a pile of it.
That's the potential opportunity, yes.
Okay.
Expanding the pool of eligible borrowers.
But on the other hand, that notorious volatility, it could make underwriting a complete nightmare for lenders, couldn't it? I mean, the value of a borrower's perceived financial health could swing wildly overnight.
You've hit on the core dilemma perfectly. The opportunities certainly lie in potentially expanding that pool of eligible borrowers, integrating new forms of wealth into the traditional financial system, and maybe even streamlining certain aspects of the lending process through blockchain tech.
Right.
For those who have accumulated substantial wealth in crypto, it offers a pathway to leverage those assets directly, maybe without having to convert them first to traditional fiat currency, government-backed money like dollars.
Which can trigger taxes, right?
Exactly. That conversion can sometimes incur significant taxes or force a sale at an inopportune moment, potentially leading to losses. So, using it directly could be appealing.
What the risks?
But the risks, yes, they are substantial and undeniable. Those rapid, unpredictable price fluctuations of cryptocurrencies mean the value of the collateral, or the borrower's declared liquid assets used for down payments or reserves, could change dramatically, even hourly sometimes. That could impact their loan-to-value ratio, maybe their ability to make payments if their other assets are tied up. Lenders would need extraordinarily robust, dynamic risk management frameworks to even begin to mitigate this.
Sounds complex.
Extremely. And borrowers would need to fully understand the inherent volatility they're signing up for. Acknowledging that their financial picture tied directly to their mortgage could be highly unstable. It's truly a brave new world for mortgage finance.
Fraught with both potential and peril, as they say.
Precise.
And this brave new world is also seeing the emergence of entirely new financial platforms, seemingly designed to facilitate these kinds of innovations, right?
Yes, that's another piece of the puzzle. The sources we looked at, particularly World Property Journal, mentioned entities like World Property Ventures, or WPV, World Property Exchange, WPE, World Property Media, World Property Markets, along with various real estate investment banks getting into this space.
So a whole new ecosystem, maybe.
It signals a broader trend. The emergence of sophisticated digital platforms aimed at streamlining transactions, expanding investment avenues, maybe even tokenizing real estate assets.
Right. Tokenization comes up a lot.
It does. It's not just about, say, tokenizing individual properties anymore, but potentially building entire digital ecosystems around real estate finance and investment.
Okay. And this reflects that broader, accelerating trend of financial innovation, digitization within the real estate industry.
I think so, yes. These platforms are explicitly seeking to make investment and property management more accessible, more efficient. For instance, some might facilitate fractional ownership of high-value properties using blockchain.
Letting smaller investors get a piece of the action.
Exactly. Allowing smaller investors to participate in lucrative real estate ventures, big apartment buildings, commercial properties without having to buy the whole thing. Others could be creating new digital marketplaces for real estate-backed securities, or even automating aspects of property management using AI and smart contracts.
Interesting.
They're effectively trying to democratize access to real estate as an asset class, moving it beyond those traditional, often exclusive channels, and importantly, creating new points of liquidity in what's historically been a very illiquid market.
Making real estate a more liquid, flexible investment through technology.
That seems to be the overarching goal, yes, breaking down those traditional barriers.
Okay, wow. So lots of change happening at the structural and financial level. But let's zoom back in a bit. While we often talk about these big national trends and macro factors, it's always important to remember that real estate is fundamentally local.
Absolutely, hyper-local.
And local policies continue to carve out very specific and sometimes highly volatile market conditions in major cities. What happens in a place like New York City, for instance, can have repercussions far beyond just its immediate boroughs, can't it?
Oh, absolutely. Political decisions made at the municipal or state level can have immediate, tangible, and sometimes really dramatic impacts on the ground. And a prime example that truly encapsulates this right now is that ongoing, highly charged rent freeze debate in New York City.
Yeah, that's been intense.
Incredibly intense. We saw Mayor Eric Adams in a CNBC video publicly assert that NYC is not a socialist city. Now, that statement was made right in the midst of this fierce public and political debate over implementing rent freezes policies that aim to cap or prevent rent increases for tenants.
It's a real battle, isn't it? Housing affordability versus property rights, economic incentives.
Exactly. It cuts right to the core of those tensions.
And the political outcomes of this debate are already having very real financial repercussions, aren't they?
They are. We saw a primary win by a pro-rent freeze candidate, Mamdani, significantly knocked shares of Flagstar Bank.
Why Flagstar?
Because of its considerable exposure to the NYC real estate market, particularly multifamily lending, and maybe even more telling, Compass CEO Robert Reskin noted, also reported by CNBC, that this specific political win has paused home buying activity in NYC more than any other single event in his 13 years in the market.
Wow. More than rate hikes, more than the pandemic.
That's what he stated, linking that specific local political outcome directly to a slowdown in market activity. It's a powerful statement.
It really illustrates precisely how local political outcomes can have these immediate, tangible financial repercussions, impacting investor confidence, directly influencing real estate transaction volumes.
And you see the arguments playing out. On one side, some argue rent freezes are, quote, a fairy tale. That's from a CNBC video discussion. They believe freezes fundamentally disincentivize new construction, discourage proper maintenance by landlords, and ultimately just worsen the housing supply crisis long term.
Economic argument.
The classic economic argument against price controls. On the other side, advocates see rent freezes as absolutely essential for housing stability, for affordability, particularly for vulnerable populations, protecting tenants from unsustainable rent hikes and potential displacement.
The social stability argument.
Exactly. The debate is fierce. The stakes are incredibly high for both residents and property owners, and the consequences, as we saw with Flagstar Bank's stock, are very real and immediate.
And we also have crucial regional market updates that further underscore this point about local impacts, right? It's not just New York.
No, definitely not. For example, Real Estate News reported that federal job cuts are beginning to impact the Washington, D.C. market. That shows how broader economic policy decisions made nationally in this case, federal budget cuts can have very concentrated regional effects on local housing demand and prices.
So fewer federal jobs means less demand in the D.C. area.
Potentially, yes. Or at least a shift in demand. Meanwhile, down south, World Property Journal provided detailed Miami May 2025 home sales data, including specifics on condo sales and prices. That offers a really localized snapshot of market health in that dynamic, high-profile area.
Which has its own unique drivers.
Totally unique drivers, often influenced heavily by international buyers, specific economic conditions tied to Latin America, tourism, completely different from D.C. or New York.
These regional reports are vital, aren't they? Because they underscore that fundamental truth in real estate. While national trends give you the context, the broad brushstroke, real success often hinges on understanding and adapting to those deeply local economic shifts.
Exactly. Those specific political decisions, the unique supply-demand dynamics within a particular metro area, even down to the neighborhood level.
Right. What works and thrives in Miami might be totally different from the challenges and opportunities in D.C. and vastly different from the situation in New York. That granularity is absolutely essential for making informed decisions, whether you're investing or just buying a home.
Couldn't agree more. You have to understand the local context.
Okay, now, for our real estate investor listeners, and I know we have many, the past week's news highlights some absolutely critical shifts, especially when it comes to profitability and, maybe more importantly now, operational strategies. It's becoming really clear that the days of just, buying almost anything, maybe slapping some paint on it and expecting it to appreciate rapidly, those days might very well be behind us, at least for now. The market demands more sophistication.
That's a very keen observation, and it ties directly back to that theme we flagged earlier from the Wire Roundup.
The Flippers Falter theme.
Exactly. Flippers falter. The warning signs shaking the housing market. A significant theme emerging is the stark reality that flipper margins were noticeably squeezed in Q1 2025. Bigger Pockets reported on this quite clearly.
Okay, so it's not just anecdotal, the data backs it up.
The data backs it up. And this isn't just a minor blip affecting some niche group of HGTV wannabes. It indicates that the days of relatively easy, rapid profits from those quick turnovers are becoming exponentially more challenging across the board.
And this squeeze on flipper margins, it suggests multiple factors are converging, right? It's not just one thing.
Definitely not. You've got the higher interest rates, which make borrowing for acquisitions and renovations much more expensive, eating directly into profit.
Carrying costs go way up.
Way up. Then you have rising material costs. Lumber, paint, appliances, everything is more expensive. Increased labor costs are a factor too. And frankly, there's just more competition now for the dwindling supply of genuinely distressed properties that make for good flips.
Right. Everyone's looking for that diamond in the rough.
Exactly. All of these factors are eating into investor returns. It's demanding a much more strategic, meticulous, almost surgical approach to acquisition. Finding the right property at the absolute right price, and then executing a flawless renovation with incredibly tight budgetary control and efficient project management.
It sounds like the margin for error is shrinking dramatically.
It is. And this is the warning sign, right? Because if the fastest money in real estate, the quick flip, is slowing down and getting squeezed, it often suggests a broader moderation in overall price appreciation and market momentum is underway.
So this begs the big question for investors listening. Is this squeeze on flippers just a temporary market adjustment, a fleeting moment of difficulty? Or does it signal a more permanent, structural shift that requires investors to fundamentally refine their entire business models?
That is the million-dollar question, isn't it? My sense, looking at the confluence of factors, is that it's leaning more towards the latter. It seems to be pushing investors away from purely speculative plays where you just bet on rapid appreciation bailing you out, and more towards genuine value-add strategies or perhaps longer-term holds.
So flipping might become less about those quick, easy gains and more about creating substantial, sustainable value through skilled renovation, smart design choices, and maybe more strategic timing on the resale.
I think that's likely where it's headed. It requires more skill, more patience, and deeper market knowledge than just riding a wave of appreciation.
And speaking of strategies and potential pitfalls, sources also pointed to a hidden risk of builder incentives. The mortgage reports noted this.
Yes, the builder incentives.
They can be incredibly attractive to buyers, right? Offering things like mortgage rate buy-downs, covering closing costs, throwing in significant upgrades.
Oh yeah, they can look very tempting on the surface.
But what's the hidden risk?
Well, sometimes these incentives can mask underlying market weaknesses in that specific community or for that builder. Or, critically for an investor or even a future resale buyer, they could potentially reduce the perceived long-term value of the property.
How so?
If everyone in the neighborhood got a huge incentive package, future appraisals might struggle to justify a higher price point based on the actual underlying value, especially if the market softens further. It might create challenges if you need to refinance or sell down the road. The comps might reflect those lower effective prices paid after incentives.
So investors really need to exercise extra due diligence here. An incentive might make the deal look sweeter up front, making that monthly payment more palatable.
Right.
But you have to understand what it might be compensating for. Yeah. Is the builder struggling to sell that specific community or floor plan? Is the base price already inflated to cover those incentives? It requires a deeper dive.
Absolutely. A cautious approach and thorough analysis are key. Don't just look at the shiny object.
Okay, so beyond just acquisition strategies, there's also a wealth of practical advice emerging for optimizing property management and investment portfolios, especially in this tighter market, right?
Yes, absolutely. Operational efficiency is becoming paramount. Sources offered some invaluable insights. For instance, BiggerPockets discussed navigating high-season summer risks in property management.
Relevant right now.
Very relevant. Think about things like AC failures in a heat wave, burst pipes from sprinklers or forgotten hoses, increased wear and tear from outdoor living. These things can eat into your cash flow quickly if you're not prepared.
And that strategic thinking also extends to crucial operational efficiencies, like tenant vetting.
Huge. Implementing proactive, thorough tenant vetting to avoid reactive evictions. BiggerPockets highlighted this too. It is far, far cheaper and much less stressful to vet properly upfront than to go through the costly, time-consuming, and often emotionally draining process of eviction later.
Prevention is better than cure.
Always in property management. Plus, understanding the 5 transformative ways professional property management can truly elevate and strengthen a real estate portfolio. RIS Media, that's RIS Media, had a piece on this.
And this isn't just about handing off the headaches, is it?
No, not at all. It's about leveraging expert systems for tenant relations, rent collection, maintenance coordination, ensuring legal compliance, which is getting more complex, and providing clear financial reporting. All of which can significantly impact your bottom line and, crucially, free up your time as the investor to focus on strategic growth, finding the next deal.
Right, working on the business, not just in it.
Exactly. And on the investment strategy front, there were some interesting ideas discussed too. Bigger Pockets talked about how to restart or even kickstart a portfolio with small multifamily properties.
Duplexes, triplexes, quads.
Exactly. An often overlooked but remarkably resilient asset class that provides multiple income streams from one property, diversifying your risk.
Makes sense.
They also cover techniques to generate significant monthly cash flow with out-of-state properties, which requires different systems and trust. And, crucially, leveraging automation to make investors more money.
Automation in what sense?
Again, from Bigger Pockets. We're talking about everything from automated rent collection and online maintenance requests to smart home tech that can monitor vacant properties for leaks or temperature issues, maybe even control access remotely.
Using tech to boost efficiency and cut costs.
Precisely. Efficiency isn't just a buzzword anymore. It's absolutely key to profitability in a moderating market where appreciation isn't guaranteed.
So for you, the investor listening, the big takeaway seems to be that maximizing returns isn't just about market timing anymore, which is getting harder and harder to predict accurately.
Very difficult.
It's about operational efficiency. It's about smart tenant management. It's about exploring diverse strategic investment models, maybe looking beyond the single-family flip.
Yeah.
Especially in a market where that appreciation might be moderating significantly.
Right. It's about building a robust, resilient portfolio that can withstand fluctuations, not just chasing those quick, speculative gains that might disappear overnight. It's about becoming a sophisticated operator, a true business manager, not just a buyer.
Okay. And now, shifting gears slightly, for homeowners, whether you're actively considering selling in this shifting climate, or maybe you're just looking to protect and enhance your most valuable asset, there's also a wealth of practical advice and important updates from the past week that can really empower you. This isn't just for the pros. This is about equipping you with the knowledge to navigate your personal real estate journey effectively in today's market.
That's absolutely right. This section is all about empowering homeowners to make informed, confident decisions in a market that is undeniably different from what we saw just a year or two ago. It really requires a different mindset, maybe different strategies than before.
So let's start with strategic selling. If you're thinking about putting your house on the market, homeowners need to be keenly aware of 5 common missteps when selling that could literally cost them thousands. Zillow put out a piece on this.
Yeah, those mistakes can be costly.
What kind of things are we talking about? Overpricing from the outset.
That's a classic one, especially now. Neglecting critical repairs that buyers will definitely spot. Poor staging or no staging at all. Bad photography still happens. Or maybe choosing the wrong agent, one who isn't adapting to the current market realities.
And related to pricing, keeping current matters made a crucial point. A home's asking price matters more today than it used to.
Absolutely. Given the current market dynamics, you can't just throw out a high number and wait for bidders to line up anymore. That initial price needs to be strategic, grounded in reality, to attract serious buyers quickly.
Right. And perhaps surprisingly, Realty Times even had a warning that all cash offers may be questionable in certain situations, emphasizing the need for extreme due diligence.
Yeah, that one caught my eye too. It seems counterintuitive, right? An all-cash offer sounds perfect.
It does. Quick close, no financing contingency. What's the issue?
Well, the warning suggests sellers need to be cautious. While often legitimate, a sudden, aggressive all-cash offer, especially one that discourages inspections or normal processes, could potentially raise red flags.
Like what? Source of funds.
Maybe concerns about the source of funds. Is it legitimate? Or could it be an attempt to bypass standard checks and balances that actually protect both the buyer and seller, like appraisals or thorough inspections? It's a vital reminder that sellers need to scrutinize the entire offer, the terms, the buyer's legitimacy, not just the attractive headline price.
So, the bottom line for sellers. With buyers steadily gaining more leverage, strategic pricing, meticulous home preparation, avoiding those common pitfalls, it's all more critical than ever for securing a successful sale at the best possible price and terms.
Couldn't have said it better myself. Preparation and strategy are key.
Okay, and beyond just selling, there was a strong emphasis this week on general homeowner preparedness and proactive maintenance. Just keeping your house in good shape.
Yes, protecting your asset. Keeping Current Matters had general advice on what every homeowner needs to know in today's shifting market.
Sure.
But it was also complemented by some very specific practical tips.
Like what?
Like preparing financially for unexpected home emergency expenses. Realty Times highlighted this because let's face it, your HVAC system, your water heater, your roof, They don't care what the interest rates are doing when they decide to fail.
So true. They always break at the worst possible time.
Always. So having that emergency fund is crucial. This holistic approach also emphasizes understanding potential changes to FEMA aid and their implications. CNBC reported on this. That's really important for anyone living in areas prone to natural disasters. Know what coverage might be available or might be changing.
Good point. And then there were really practical tips too, like landscaping and pests.
Yeah, down-to-earth stuff. RIS Media had tips for summer landscaping conservation ways to save water, save money, and still have a nice yard. And Realty Times offered essential pest control advice.
Which sounds minor, but isn't.
Definitely not minor. Proactive maintenance and pest control can prevent significant structural damage. Think termites, carpenter ants, rodents. It protects your property value, ensures the long-term health and safety of your home. It's all about preserving your most valuable asset in what can be an unpredictable environment.
Right. It's not just about market timing. It's about stewardship of your home.
Exactly. Stewardship. I like that word.
And despite all these current market complexities we've discussed, the shifting sales, the legal changes, the need for diligence is tapped, there was also a consistent and frankly, reassuring perspective emerging this week.
Oh, yeah.
That homeownership fundamentally is going to be worth it in the long run. Keeping current matters provided this valuable long-term view. A reminder not to get caught up solely in the short-term fluctuations in headlines.
That's such a crucial reminder, especially when the market feels uncertain. For many, probably most people, a home is far more than just a line item on a balance sheet. It's a long-term commitment. It's a foundational asset for potentially building generational wealth. It provides family stability, a sense of security, community connection.
Things you can't always put a price tag on.
Exactly. This enduring perspective provides important reassurance amidst all the short-term market noise. It reminds us of the fundamental, enduring value of owning a home as a bedrock for personal and financial well-being. It really is a marathon, not a sprint.
Well said. Okay, let's try to bring this all together.
All right, so as we wrap up this deep dive into the real estate landscape of the past week, drawing extensively from all those insights that fed into the Wire Roundup, we've definitely seen a market that is undeniably in a state of, let's call it, nuanced transition.
Nuanced is a good word for it.
It really is. It's far from a simple boom or bust narrative. And it's certainly a period demanding agility, insight, and careful navigation from everyone involved. Our first major theme, navigating a shifting market landscape, revealed those fascinating mixed signals, didn't it? While new home sales are still facing significant headwinds, those high rates, affordability issues existing, and pending sales showed surprising resilience.
Right. Holding up better than expected.
Exactly. And crucially, we're seeing those tangible shifts in housing inventory finally starting to build, coupled with a moderation in price growth. Together, these are putting more leverage back into buyers' hands and fundamentally altering that sales dynamic we've gotten used to.
Okay, theme 1. Shifting landscape, buyer leverage increasing. What was theme 2?
Theme 2 was evolving industry structure and regulation. This highlighted those profound legal shifts, particularly the final approval of those landmark commission settlements. That promises to fundamentally reshape how agents are compensated and how transactions actually occur going forward.
Big changes there.
Huge changes. We also observed fierce competition among brokerages, leading to significant consolidation happening across the country. Smaller players joining forces, larger players expanding.
And the surprise.
And then the really intriguing, potentially revolutionary emergence of cryptocurrencies in mainstream mortgage finance. That's the genuinely surprising and significant innovation to watch.
Yeah.
With even government-backed entities like the FHFA actively exploring their integration into traditional mortgage underwriting, that signals a potential paradigm shift in how we might access home financing in the future.
Okay. And the third theme?
Finally, for investors and homeowners, the overarching message from this past week's news is abundantly clear. Adaptability is paramount. We saw confirmation that flipping margins are undeniably tightening the flippers Falter theme.
Right. Demanding sharper strategies.
Exactly. Demanding sharper, more strategic approaches from investors who can no longer just rely on rapid appreciation to make their profits. Meanwhile, homeowners need to be more prepared, more strategic than ever in this evolving landscape. Whether they're looking to sell for top dollar or simply maintain and protect their most valuable asset for the long haul, preparedness and strategy are key for everyone.
Okay, that's a great recap. What truly stands out from this week's deep dive, the real aha moment for me personally, was the sheer speed and the profound seriousness with which traditional financial institutions and even prominent political figures are now exploring and actually beginning to legitimize cryptocurrencies for mortgage underwriting.
Yeah, the pace is surprising.
It really is. This isn't just some niche interest for tech enthusiasts lurking in dark corners of the internet anymore. It feels like a palpable shift that could fundamentally redefine how we access homeownership down the line. It injects a completely new layer of complexity for sure, but also potentially incredible opportunity into the market. It feels like a potential game changer we absolutely need to keep a very close eye on because it directly impacts the very mechanisms of housing finance.
And to echo that, I think the overarching takeaway for you, the listener, from this past week's news is that the real estate market is undeniably shedding some of its previous frenetic, almost unsustainable pace.
Cooling off, but not collapsing.
Exactly. It is now demanding a much more informed, strategic, and agile approach from everyone involved, from the largest institutional investor right down to the first-time homebuyer navigating the process. Success in today's real estate environment isn't about simply riding some unsustainable wave of appreciation anymore.
No.
It's about deeply understanding the intricate interplay of those macroeconomic factors, the micro-level industry shifts like commissions and crypto, and those highly localized policy impacts we talked about.
Understanding all moving parts.
All the moving parts. It's about leveraging newfound transparency, actively exploring potentially innovative financing tools like crypto mortgages perhaps down the road, and consistently focusing on sound, long-term decisions rather than just short-term speculation. The market isn't in free fall, but it absolutely demands sophistication, diligence, and unparalleled agility from all participants now.
Okay, so that leads me to a final provocative thought for everyone listening to mull over.
Yeah.
Given all of these monumental shifts we've discussed, the increasing transparency, the landmark legal changes in commissions that are transforming agent roles, and these potentially radical new financial instruments like crypto and mortgages, how might the traditional role of a real estate agent need to evolve beyond just facilitating the transaction?
Interesting question.
Are we entering an era where agents must become true financial and strategic advisors, guiding clients through this increasingly complex maze of options and regulations to remain truly indispensable? Does their value proposition need to fundamentally shift?
Beyond just opening doors and writing offers.
Exactly. It really makes me wonder, are we just at the very beginning of the biggest transformation the real estate industry has seen in decades? One that goes far beyond just how homes are bought and sold, but reshapes the roles of everyone involved.
That's a fascinating question to leave people with. Lots to think about there.
Indeed. Thanks for joining us on this deep dive. We truly hope this extensive conversation has given you a clearer picture and some valuable insights to confidently navigate the current real estate landscape.
Hope it was helpful.
Until next time, keep learning, keep questioning, and keep exploring.
If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, The Week in Real Estate. Thank you for listening.